Hi folks, welcome to the second part of our Chase Corporation cash flow video. In the second part we're going to be looking at calculating cash flow from investing activities. So just a little recap, you'll remember that we initially calculated the cash flow from operating activities, and operating activities go first, and we wound up with $48,200. Cash flow from investing activities, we have a number here which says it's negative $12,000, which means we used up $12,000 at net in investing activities. And let's have a look at how we did that. Well, there's two accounts, if you go back to the problem, that will impact investing activities. There are long-term investments, and then there's property, plant, and equipment. So now we need to figure out how much of an impact the investment sale, because we can see the investment went down by $1,000, and we can also see that the property, plant, and equipment went up by $21,000. It went from $170,000 to $191,000. So what's the net impact of those transactions that impacted the long-term investments in property, plant, and equipment? What's the impact on cash flow? Well, the first thing I would do is remember that the differences in those accounts, so the fact that in long-term investments went from $40,000 to $39,000, that's just the difference in the actual account itself. That's got nothing to do with how much cash we generated from that sale. Similarly, when we bought equipment, we bought an additional $21,000 of property, plant, and equipment. That doesn't necessarily mean that we spent it all in cash, although in this case we did. But we have to have a look at that, what happened. So the best thing to do would be to look at the T accounts. We know that for long-term investments, we went from $40,000 debit to $39,000 credit. So that means that we must have sold $1,000 in investments. So part of our journal entry, if we were trying to recreate what happened, would be the long-term investment was credited for $1,000 because it went down, and that's a credit, right? When an asset goes down. Now we also know from the question that when we sold the long-term investment, the income statement had there a gain on the sale of investment. So we know that a gain was created. So how much cash would we have had to have gotten in order to create this gain while we got rid of the investment? Well, that must be $9,000. So we now know that when we got rid of that $1,000 investment, we generated $9,000 in cash flow. If we now look at the other account that impacts cash flow, we know that we had property, plant, and equipment of $170,000. $191,000 is the ending balance in that account. So during 2011, we must have purchased $21,000 in equipment. There's no indication anywhere in the question that that was done for anything other than cash. So this must have been the journal entry that we recorded in order to record that equipment purchase, and cash went down. So therefore, these two cash flow activities give us a net impact on cash flow from investing activities, which is an outflow, as we've said here, it's an outflow, right, of $12,000. So far we've got an inflow from operating of $48,200 and an outflow of $12,000. Now what we want to do is we want to go and have a look at the financing activities and see what happened there. So I'm just going to get some of my other documents ready here, and then we'll move on to the financing activity section. Okay, folks, now we're going to have a look at the financing activity side. So let's begin. We know that from our question, there were a few different things that happened. We can see that, first of all, I guess we need to go back and look at what kinds of activities impact financing. Well, whenever you incur debt in order to help you finance your business, so when you issue bonds, that's a financing activity because it brings cash in. So you borrowed money from lending institutions to bring cash into your business. Whenever you issue shares. And again, most cases, whenever you pay dividends, right? So now, if we're assuming here that we pay dividends, which there is really no item in here that says we did, but I know when we go through the calculations we're going to see that there were some dividends paid. Let's focus first of all on the liabilities, the long-term liability section here, which looks at bonds payable, and the equity part, which looks at common shares, and see if we can figure out how much cash was generated or used up. when our bonds payable balances changed. They went from 90,000 to 100,000, and our common shares went from 37,000 to 40,000. Well, first of all, what do you know? If bonds go from 90 to 100,000, that means 10,000 in new bonds must have been issued. So you must have got from the lender that extra 10,000, and you increased your liability by 10,000. Since issuing bonds is a financing inflow, that means that we now have to debit cash and credit bonds payable to record that. This is the inflow of cash. So when we're doing our cash flow, we know that we generated $10,000 in cash when we issued the bonds. Now we also know that we issued shares. Let's have a look at how that happened. Well, we know the shares went from 37,000 to 40,000. So the journal entry must have been made during the year to increase cash by 3,000, which was the dollar amount that we received from investors who bought our shares, and we credited common shares for 3,000. So therefore, we have the $3,000 amount here. Now the big question is, we also know, particularly if you're an ASPE company, we know that when you pay out cash dividends, it's a financing activity. That's an option under IFRS, but since our question didn't tell us what they chose, and what kind of a company we had here, whether it was following private or public standards, we just assumed here that it was following ASPE and it was a financing activity. It could have been following IFRS as well, and then they would have made a choice to include dividends as a financing activity. You remember there are other options under IFRS when we're dealing with dividends. In this case, we're going to assume that it was a financing activity. In that case, the only account that we can really look at to determine whether or not or how much of any cash flow was paid in dividends, if anything, is to go through a T account. So let's start. We can see here that our retained earnings, we know from our question, started at 50,000 and ended up at 34,000. So how did that happen? You remember in the question, income of 38,200 was earned during the year. So we have a subtotal before there were any dividends declared and paid of 88,200. Don't forget, retained earnings at the beginning of any year, plus net income less dividends declared is going to give you retained earnings at the end. That's something we learned in intro financial, right? So we know at the beginning we had 50,000, right? We also know that during the year we had 38,200 in net income, right? So we know that these two together are going to give us 88,200. To get the ending balance, right, which we are given in our question, is 34,000. We need to figure out this guy in here, the amount of dividends that were declared. And the dividends declared would have been whatever it took to reduce our retained earnings from 88,200 to 34,000, and that would have been 54,200. So you might be thinking, well, how do we know that was actually dividends paid? Because this is just dividends declared. They could have been declared and paid at a later date, but that's not the case in our question, because nowhere in the liability section does it indicate that we have a dividends payable. And dividends payable would have prominently been shown on the balance sheet. So because we don't see dividends payable in the liability section, we know that everything that was declared was actually paid during the year. So if we now go to our cash flow, we know that that's a drawdown on cash. So if we add these three numbers, we're going to get a net cash outflow of 41,200. So now, if we took the inflow of 48,200 from operating and the two outflows, one from investing, one from financing, we're going to get a net change in cash during the period, which is an outflow of cash of 5,000. We also know that our cash flow at the beginning of the year, January 1st, 2011, was 20,000. So we fully reconciled now how our ending cash balance at the end of December 2011 got to be 15,000. So now we can explain to our senior officials in our organization what kinds of activities brought our cash flow from $20,000 to $15,000. So this concludes our video on cash flow from investing and financing activities.